So Tom Lee, one of the best in the business, was just on CNBC and he dropped some massive bombshells you don't want to miss. Now, he left the host absolutely speechless because what he said literally changes everything. I'm going to give you a little taste and then we'll talk about it. Check it out.
But FundStrat's Tom Lee says it's temporary, a temporary moment of pain and a buy the dip opportunity. He joins me now, Post 9, to make that case. Good to see you again. I'm glad you're here in person, too.
Now, let me give you the setup of what's going on here. Now, Tom Lee was the most ridiculed analyst on CNBC because he said that 2023 is going to be a massive, explosive year for the stock market, while the rest of these clowns said it's going to be a bad year, this clown included. Now, 2023 ended up being exactly what he predicted, and now he's back on CNBC as the guest of honor, rightfully so, right? And he's talking about 2024, and he's saying, look, 2024 is going to be a great year. Don't worry, this is all temporary. It's a temporary pain. It's going to be a great year. And his rationale is very simple. He's saying, look, inflation is dead. We're just waiting for the autopsy report to find it out officially, but it's gone. It's just a matter of time. Now, he did also say that March is going to be cooler than expected, which didn't happen, but a day later, the PPI data came out, the wholesale inflation, and it was cooler than expected. So he wasn't exactly wrong. Now, to be fair, there's a whole camp, really just absolutely 180 of what Tom Lee is saying. Larry Summers is in that camp, Jamie Dimon is in that camp, and they're basically saying the opposite of what Tom Lee is saying. And to my credit, I've always showed you both sides of the argument. There's videos on my channel of Larry Summers, of Jamie Dimon, and Tom Lee. I give you all the opinions and explain to you what they mean so you can make up your own mind. I don't force feed you my own narratives and my own opinions. And I'm not going to do it in this video, but I will tell you what Tom Lee said here because he brought up some really interesting arguments. Check it out.
I think the narrative got muddled because that CPI report was a disappointment, but it was driven by what we'd call stubborn components, shelter, auto insurance. You know, the median core CPI component now has only 1.7% year-over-year inflation. I mean, inflation is normalizing. It's just not evident in the total picture.
Now, what he's talking about here is a little bit of a narrative change that we experienced after the March inflation came in hotter than expected. Before the March inflation, everybody was certain we're going to have 3 rate cuts in 2024. Now, they're not so certain. Maybe 1, maybe 2, maybe none. Some are talking about hikes. Now, he's saying, look, guys, what's driving inflation up right now is the 2 most lagging indicators, which is shelter and insurance. And that is absolutely true. Shelter and insurance are up higher than everything else. And those take a while to cool down because you only renew your insurance once a year and you only renew your rent once per year. So these things, they don't cool down right away. 100%. But there is a counter argument here I think you should know. If I was on the show, I would have pushed back on that. And I would have said, Mr. Tom Lee, look, I get it and I 100% agree. But look, if you look at Supercore, which excludes shelter, which excludes food, and excludes energy, it's up 4.8%. And based on the last 3 months, it's running on an annualized rate of 8%. It is accelerating into an 8% territory. So Supercore, which does not include any of the items you're talking about, is still running up and accelerating way harder than anything else. And that's a valid counter argument. We can't just ignore it. But on the flip side of that, Tom Lee would have answered to me and said, look, Tom, I get it, but look at the PPI data. The PPI data is the leading indicator because it shows us what's the cost of goods like. If the wholesale inflation is cooler than expected, then the products that will be produced using those same raw materials will be eventually cheaper, which will drive inflation down. So if PPI is down, it's cooler, then there's no reason we're going to have hotter CPI long term. 100% agree. I'm not forcing you to choose any of these arguments. I'm just giving you both sides of the picture. Now, in this next clip, he actually talks about what needs to happen for the narrative to change back to the positivity we had before March, and he actually gives some really interesting insights. Check it out.
So what we would need to see is April and May CPI improvements, which is in the future, and then keeps the Fed from standing in the way of the economy. What we don't want is a Fed that wants to further slow the economy, which is rate hikes. And I think if they just do even 1 hike this year, it's still actually a good environment for stocks.
One cut, you mean?
Sorry, 1 cut.
Yeah, let's be clear. See, that's a Freudian slip. I mean, because the greatest fear of all is that they're going to have to hike again, however remote that possibility seems today. And even if you put into the soup, all the Fed commentary that we've gotten of late just seems to be push off rather than push up.
That's right. And I think it's, at the end of the day, it's even this CPI does look like it's somewhat sticky. PCE, as you pointed out, is more cooperative than PPI is, and measures like Truflation show inflation much softer, inflation expectations much lower. So I think at some point we could also just ask, is CPI a bit aberrant?
And this is exactly why Tom Lee is one of my favorite analysts. He always gives a direct answer. He's not afraid. He has balls of steel. And he basically said one simple thing. If April and May CPI comes in better than expected, the entire narrative is going to flip again like a Wiener Schnitzel. And we're all going to be laughing about how March used to scare us. 100% right. And he's not the only guy who's saying it, by the way. Larry Summers literally said the same thing in his very bearish outlook. I'll talk about that in a second. And he's from the opposite camp. But he's basically saying, look, guys, if April and May comes in cooler, then we're back to normal. But even if you're not back to normal, even if CPI is stickier than what I thought, Tom Lee, right? It doesn't really matter. As long as this year ends with either one rate cut or no rate cuts, but there's no hikes this year, the stock market is going to be okay. And that's an important thing to note. Tom Lee isn't basing his bullish outlook for the rest of 2024, and I'll tell you exactly what his target number is going to blow your mind. Trust me, he actually gives a number for the S&P 500. But he's saying this is not based on my expectation of a 3-rate cut. If that happens, great. But if it doesn't, we're still going to hit that target. And you're going to hear about that target in this next clip. Check it out.
What about the valuations of the market? How do you counter the argument that they're just way too stretched? Multiples are just way too rich, given what now is likely to be the case of cuts later on.
I think when someone looks at 20 years of history, that's the argument they'll make. If they look at 90 years of PE multiples versus interest rates, when the 10 years between 4 and 5%, which is a pretty big range, the median PE is 20 times. So we're not even at a median PE multiple of what's existed whenever the 10 years been in this range. So, and then if you look at the median stock, it's actually at 16 times. I'd say that there's upside to earnings. I think multiples can expand. I don't think 5,200 is the ceiling for stocks this year.
What feels like the right ceiling now?
I know this is going to be tough for investors to embrace it, but I think something like 56, 5,700 is probably where the S&P exits the year.
Now, in this next clip, he was asked about valuations, whether valuations are too high right now, and obviously he said no. But then the conversation basically kind of gravitated towards his target for the S&P 500, currently at the 5,200 mark, the all-time high. And he said, look, by the end of the year, I expect a 5,700 S&P 500. Now, that's a 10% increase on the S&P 500. That means that stocks like Palantir with 3 beta are going to increase 30% this year. At least that's what Tom Lee is saying. Now, look, at the end of the day, here's what Tom Lee is saying. Look, I think that we're going to have a great year. I think Tom Lee thinks that we're going to have a 5,700 S&P 500 because we're going to have a couple of rate cuts, maybe 1, maybe 2, maybe 3. But most importantly, we're going to have certainty. We're going to have clarity because we will know exactly where we stand by the end of this year as far as 2025 goes. And clarity, certainty, they're worth a lot of money in the stock market.
Maybe even higher.
Much more backloaded into that than you once thought?
I think it's still backloaded because we'll have the cuts behind us and we'll have visibility into 2025 earnings, which probably could be 270, maybe 280 next year.
No, look, he's absolutely right. Look at the CME FedWatch tool, the one that predicts the percentages, the odds at which a Fed cut is going to come in the next month, next few months, whatnot. These change a lot. Every time something happens, the percentages shift. They move around. And again, that's exactly what Larry Summers said. In my video about Larry Summers, which I'll link at the description of this video, he was talking about a bearish outlook for the market, but he said, look, anything can happen because everything can change tomorrow. And once that happens, we have a new set of facts to work on, new conclusions. So the fact is that I don't see a rate cut right now doesn't mean that can happen in 2 months, which is exactly what Tom Lee is saying. Things can change and that change is going to be worth a lot of money. He just believes or happens to believe that that change is going to be cooler than expected inflation.
You think the first one's in July?
Or it could be September. Probability of a June cut has been reduced, but it can come back if we have a good April and May CPI, because then it's going to put back into focus what is the trend in CPI. It does feel stubborn when you look at January, February, March.
Now, he's also said something really crazy here because he's essentially saying, look, I'm not excluding a June rate cut because June is still too far away. If April and May become cooler than expected, there's no reason that June can't be the first month for the Fed to cut rates. And yeah, I agree. If April and May become cooler, that can happen. The problem, the counter argument here is, look, I've told you this, you have to compare yourself always to the previous year's month. So January compares with January, February with February, etc., etc. So in February of 2023, we had 6% inflation, right? easy to beat. In January of 2023, we had 6.4% inflation, easy to beat. Even in March, we had 5% inflation last year, easy to beat. But if you look right now at April and at May, we're looking at 4% and 3%. 4 and 3. So you have to beat 4% and you have to beat 3% in April and May for this prediction to pan out. It's a tough number to go against. 4 and 3 are going to be hard to beat. It's always compared to the previous year, the increase or the decrease. So I'm not sure. In fact, if I had to bet, although I'm not a betting man, I would say we don't have a chance for a June cut. But I think the most likely scenario is September, November, December. Those 3 months, either 0 to 3, but they come in September, November, December. But hey, I'm going to give you actually a system here to know ahead of time, kind of, where the wind is blowing, so to speak, right? If you look at oil prices are a really great leading indicator for inflation. If oil prices shoot up all of a sudden because of geopolitics, because of OPEC, because of different things, if oil prices shoot up, you can expect a higher CPI data, as simple as that. So I would focus most of all, obviously after listening to Larry Summers and Jamie Dimon and Tom Lee, my conclusion is any one of them can be right. But the decision who won the whole debate is not based on the quality of their arguments, is based on the facts, because all of them make great arguments. But the question is what the oil prices will be, what the cost of goods will be, will determine, because they're all saying the right thing, but it's based on how good or bad inflation is going to be. Now, I would focus on oil prices, and if oil prices start spiking up for the rest of the year, we're going to be in big trouble. If they relax, we're going to be fine. As simple as that. And obviously, as a smart investor, you have to acknowledge the fact that you don't know the future. We don't know if Tom Lee is right, if Jamie Dimon is right, if Larry Summers is right. So you have to mitigate. You have to prepare for the risk just in case. So there's a few things you can do here as a smart investor. Number one is if you're up big on a stock, if you have massive profits, take out 30%. So you're playing with house money. Number two, make sure you set stop losses to your biggest winners so you don't get wiped out in a single day if anything bad happens. Number three, consider adding money market funds. Bond exposure in higher interest environment is going to pay off. Now, if things go south and the market goes great, then bonds are not going to be as good, but they're still going to give you what they give you. You're not going to lose your pants. And of course, number four, maintain long-term investing psychology. Understand that you're playing 10-year increments. If 2024 doesn't end up exactly like they should be, it doesn't matter. 10-year, 15-year game, that's your whole key. Now, as always, I would love to have you join our community. It's free to join, discord.gg/Tom Nash. We're almost at 10,000 members. We have a lot of resources, a lot of chats going on, a lot of great smart people talking about stocks, talking about investing. And honestly, I think we have one of the best, if not the best, investing communities on the planet. Would love for you to join. It's free to join, discord.gg/Tom Nash. And of course, you're more than welcome to join our Patreon, where we will teach you how to become a better investor. It's not cheap. It's not for everyone. You're not going to get stock tips. We're actually going to teach you skills. It's not really for the everyday day traders and the people who want easy money. If you actually want to invest in a long-term process to learn, join the Patreon, join the Academy, patreon.com/Tom Nash. I know that most people are not going to find that attractive, and that's by design. Now, one final thing. 25% off of Stock MVP right now. If you go get it right now, code name Tom25, 25% off, and it locks in your price for your lifetime of use of Stock MVP, stock-mvp.com. At the end of the day, we build this platform for you guys, the retail investors who are fed up by being screwed by the institutionals. Go check it out, try it out, 1 week for free to try it out. If you love it, let me know. If you don't, also let me know what we can improve. I'll see you in the next one. Peace. As long as the Fed just keeps it as is, or maybe even gives it one little Fed red kite. What did I just say? Red kite? I meant a Fed rate cut? Woof.